12 months ago, BlackRock predicted that the stock market will keep growing and we will not have a soft nor a hard landing. They were right, since this is exactly what happened. So now that they published their 2025 predictions, let's see what they predict for the stock market, inflation, Bitcoin, and more. The global economy is reshaped by what BlackRock calls the 5 mega forces. The first one is an aging workforce, which can be seen in the developed markets, and it might be inflationary because less people are available to fill in the jobs. The second one is the geopolitical fragmentation, which might only get more intense after Trump became the US president. The next ones are the digitalization of finance, the energy transition, and of course, artificial intelligence. And they argue that if we look back at 2024, there are clear signs that we are not in a typical business cycle. If this was a typical business cycle, the US growth should have slowed down as tighter financial conditions brought down inflation. However, we haven't seen that. While inflation has eased, growth has not, and the main reason why economic growth remains strong are the adoption of AI and the energy transition that comes with it. BlackRock believes that the adoption of AI will be done in 3 phases. We have build-out, adoption, and transformation. And right now, the data centers are the backbone of this build-out, but the costs for AI data centers are very elevated. As a result, investments across AI, data centers, and related power infrastructure could surpass $700 billion per year by 2030. BlackRock argues that the sheer amount of capital needed to enter this space gives mega-cap tech companies a competitive advantage because of the barriers to train their model. And even after the recent reveal of AI model DeepSeek, BlackRock believes that the investments into AI will continue. But how will this AI adoption transition into the stock market? Is it going to start the next bull market, or perhaps create the next bubble? BlackRock estimates that on the AI timeline, we are just starting, and that there are years of solid growth ahead. As a result, they believe that investors should broaden out their horizon. Instead of relying on broad assets like equities, they should look for specific themes generated by these structural shifts. They believe active strategies and investment expertise will provide an advantage in this environment. Moreover, the fact that the S&P 500 looks very different from just 5 years ago, with far more concentration, is another argument in favor of active investing. But the most important thing to take away from this is that BlackRock remains pro taking risks, because they have great confidence in the US companies. And historically, US companies have persistently outperformed their global peers. This graphic is seriously impressive because it shows exactly why the US stock market performed so well. And it is all about the quality of earnings. And moreover, BlackRock believes that this trend will continue because the US will benefit more from the 5 mega forces. This, in conjunction with potential tax cuts and regulatory easing, makes BlackRock remain bullish on US equities, particularly relative to international peers. But what particular stocks should we look for? Well, BlackRock believes that the AI boom will benefit 3 types of investments. Firstly, the build-out beneficiaries, meaning the foundational layers of the AI tech stack. These include cloud infrastructure, chips, data management systems, and energy. The second type of investment is the mega caps. These remain key beneficiaries of the build-out, even if some of them may ultimately be disrupted. Moreover, they admit that some AI valuations may be rich, and that is why they remain cautious. To sum up the US stock market in 2025, BlackRock created several scenarios for the US economy based firstly on growth. They estimate that the US economy will grow slower than before the pandemic. Secondly, they believe that treasury yields will remain high in the United States because of inflation. And lastly, they argue that valuations are not ahead of fundamentals. Considering all these, they see US corporate strength as the most likely scenario, and they estimate that the US stocks will grow while the US bonds will underperform. As a result, they are not a buyer of US bonds because they estimate that treasury yields will remain higher than historically, which will make US bonds suffer. But BlackRock argues that investors don't necessarily need bonds to diversify since other options exist. BlackRock believes that we can find good diversifiers like traditional gold or new ones like Bitcoin. Trump's support for Bitcoin, in conjunction with investors' belief that it will be more widely adopted as a payment technology, should make Bitcoin less correlated with stocks and other risk assets in the long term. But in spite of this positive outlook, there are still a few possible risks that BlackRock says we should follow closely. The first thing that we should keep an eye on is an escalation of the trade wars. They argue that the US-China competition is only set to intensify, especially in strategic sectors like semiconductors and technology. They conclude that geopolitical risk is elevated and a series of shocks hang over the global economy. Another risk is related to the long-term bond yields, which grew after Trump became president. A continuation of this trend would be worrisome in their view. To sum up, BlackRock remains bullish on the US economy in 2025. They see the US continuing to grow because of AI and the energy transition. They are overweight US equities because they have the strongest earnings potential. Still, they expect the treasury yields to remain higher than the market anticipates, which will hurt US bonds. That was it from me. If you feel like you've learned anything of value or you wanna see more videos like this one, please hit that like button and subscribe.